everybody. Welcome. We are live on Facebook as well. This is the monthly market insight for May. So Sean and I host a live monthly market webinar the first Monday of every month. So we welcome you to send in questions. Sean and I will kind of talk about what's happening in the markets, things, conversations that we're having with clients, and kind of address some questions that we get along the way month to month. So let's dive right in, Sean. Sean's going to kind of show us some data and how all of that information has impacted the market performance kind of year to date. He'll take a look at things to note on CPI, unemployment, what this all means, how this has impacted the market, and kind of internationally, domestically, things like that. So Sean, I'll have you take it from here.
Yeah, awesome. I will share my screen. And we'll kind of talk about the market. So far, May has been a busy month. What we had was on April 30th and May 1st, Jerome Powell and the Fed got together, and they made a decision on what they're going to do with interest rates. And they decided to leave them where they're at. So federal interest rates remain between 5.25 and 5.5%. So no real big announcements there. What was different was the Fed's rhetoric. So they were saying, hey, we still believe that next time we get together, that there's a higher probability that we lower interest rates rather than raise interest rates. Now, that's completely different than their March meeting when they said they still plan on lowering rates 3 times in 2024. So in the November meeting and the March meeting, they said we plan on lowering rates in 2024. March, he said we still plan on doing 3 rate cuts in 2024. May came out and the Fed said, yeah, we may actually raise rates next time, but we still think there's a better chance that we lower them at our next meeting. So that was a big course reversal, or what the news likes to say, a hawkish stance by Jerome Powell and the Fed. And this is why. Okay, so if we go back to early 2022, that was a really, really tough year in the market. At one point, the markets were down about 25%. They ended up down for the year at about 20%. So a pretty bad year in 2022. And that was because we had rapid inflation. The Fed was raising interest rates. We can see our consumer price index, or a measure of inflation, here at the top of our chart. We've got the US stock market in blue. We've got the total bond market in red. Then we have international stocks in yellow. So as we see the consumer price index rising from 7.5, it actually peaked in June of 2022 at 9.1, the markets really, really pulled back. And that's because the Fed was raising interest rates as inflation was getting out of control. So that was the way that the Fed combated rising inflation. And at the same time, we've got our unemployment number here at the bottom. So unemployment's remained fairly low throughout this entire time period. It's ranged from about 3.4% up to 4% since the beginning of 2022. Now, a little bit of that is changing recently. We'll get into that. But what we want to focus on now is this inflation. Inflation was rising in 2022. We saw markets pulling back big time in 2022. As inflation started to come over the hump and started to reverse course and start to drop, we saw the market start to rebound. And that really continued into 2023, where the markets had a phenomenal year in 2023. So markets were up almost 25% in the US stock market in 2023. And that's because the market said, okay, the Fed's got inflation under control. They were raising interest rates, inflation's coming down. We still have really low unemployment, and that's good for the economy, because when people have jobs, they have money. When they have money, they spend money. And when people spend money, it's really good for companies. So the markets like that we have low unemployment, we have a lot of consumer spending, inflation's trending down, the Feds decide they're not going to raise interest rates anymore. Markets do really, really well into 2023. And if you look here at the end of 2023, right around that November timeframe, right when the Fed came out and said, we plan on lowering rates 3 times in 2024, we had a huge finish to the end of 2023. November, December were phenomenal months in 2023. The market really, really liked that. And that continued into 2024. So through January, really through the end of March, we saw the markets continue to trend up. And it looked like we're going to have the same run in 2023 as we were in 2024, except we got some bad inflation numbers again. So we can see inflation started coming down. It got to a low of about 3.1 in that November time period. The Fed was really optimistic. Markets got optimistic. And then so far in 2024, we've seen inflation kind of reverse courses and start to trend up again. So our last reading was about 3.5%. Again, another increase. We've had 3 inflation readings in 2024, and 2 of them have actually shown an increase. So the markets are starting to get a little wary. The markets were down in April, and then the Fed comes out May 1st and says, hey, we may actually raise rates, next time we talk about this, which is completely different than what he said in November and March. But underneath all of that, we still have really low unemployment. So we got on May 3rd, we got this month's unemployment number, and it's at 3.9%. So we've seen a slight increase in unemployment, which creates some concern in April, of 2024, along with rising inflation that said, maybe this is getting out of control from the Fed, and we're going to have rising unemployment, which will be bad for the market. And we've got inflation trending up again, which again would be bad for the market. So I say all of that. In the last couple of days, the market's done pretty well because they say, hey, the Fed's still thinking about lowering interest rates, and unemployment didn't rise too much. Now we get the next data point on May 15th. That's when we get this next consumer price index, this next inflation measure. And that's going to have a big decision on how the markets move over the next couple of months and over the summer. Because if we see that number come down, the market's going to be very happy. And they're going to say, hey, the Fed still wants to lower rates. They're still continuing that thought process, even though they brought the potential for a rate increase next time. They still plan on lowering them. That's still a higher probability than them raising them. And we have inflation trending down again. So that's going to be the next data point, is going to be May 15th. What you can see is the U.S. stock market lost about 20% in 2022, got about 25% of that back in 2023, and then it's up about 5% here in 2024. So we look at the markets in 2024, again, January through March, everything was great, right? Markets were loving that inflation was coming down. They loved the low unemployment. We get a couple of bad inflation metrics. April, the market pulls back, but we're still positive so far throughout the year. The bond market is down. And again, bonds are going to act inversely correlated to interest rates. So as the Fed raises interest rates, the bond prices are going to fall. And that's because they're not quite sure what they need to offer for their interest rate. And therefore, if I own a 3% bond, the Fed's paying 5.5%, I'd be much better off selling my 3% bond and buying a federal bond at 5%. So as people sell off those lower coupon bonds, it lowers the price of those bonds. So that could be good if the Fed does actually lower interest rates. People that bought bonds here really since 2022 got some very favorable interest rate coupons that they're getting from those bonds. So bond prices may rise as inflation comes down, as the Fed starts to lower rates, if and when that happens. And that's really our advice, is let's not try to time the market. Let's not try and predict what the Fed's going to do, because as we've seen over the last 18 months or so, the Fed changes their mind every 60 days. They get new data. They get a new pulse on the market, and they may say they're going to raise them, and they end up leaving them where they're at. They say they may lower them, and they decide, you know what, we're not ready to lower them. We're getting bad inflation measures. So if the Fed doesn't know what's going on, certainly we as investors are going to be a little bit patient as well. So that's kind of how the markets have done in 2024, and what's really caused a lot of this pullback and the gain going into 2023, how the markets are reacting in 2024. So again, May 15th, big number from the consumer price index. What we've done for our clients is we've been a little bit patient with cash that's come into the portfolio. And that's because we say, we don't know what's happening with inflation right now. It was trending down. It's been trending up for 2024. Let's stay patient until we get a good idea what's happening with inflation. And again, May 15th is going to be that big inflection point for us. If we see inflation rise, we think there could be a higher probability of the market pulling back 10% than it is gaining 10%. If inflation falls a little bit or things start trending in the right direction, again, it could be a really good sign for the economy throughout 2024.
Thanks, Sean. One of the questions and kind of commentary that we've had with clients is, why is there so much emphasis or value put on the Fed's rhetoric in terms of timing based on how they can control inflation?
Yeah, so every time they talk, it's going to move the markets. And that's because if I'm a shareholder, right, if I own equities or I own a stock, I am betting that that company's going to grow at a certain percentage every year. If all of a sudden the Fed raises interest rates, then I'm losing some of my real return. So if they raise them to 5% and I expect them to be around 2%, then I've got to go get a 3% difference in my overall return. So the value of my shares are going to drop. That's why the market pulls back, because I need that company to return a higher value than I was expecting it to return for me to actually take home more money. So when we see the Fed come out and talk, it's going to move equity prices, it's going to move market prices, stock prices. And the same is true for bonds, because if the Fed raises interest rates, my bond prices are going to lose value. And if they lower interest rates, my bond prices are going to gain value. So every time they talk, it's going to make a big movement inside the market, because that's going to help set people's discount rate and what they need in their actual return.
Thanks, Sean. I don't see any other questions pop in. We'll check Facebook Live. Thank you for everybody jumping in. We'll send a recording to all of our clients as well. If you have questions, as always, please send those to Sean and I. You can reply to the email. And we look forward to seeing you in June.
Thanks, everyone.